Welcome to the July 2023 Executive Committee meeting of the Board of Education Retirement System. Today is Thursday, July 13th, 2023, and the time is 1:10 p.m. As a reminder, please note that the committee meeting is being recorded and will be posted to the NYCBERS YouTube channel. I'll start the meeting by calling the roll. Anthony Giordano.
Present but remote.
John Manrich.
Present.
Donald Nesbitt.
Present.
Corinne Apollone.
Present.
We have a quorum. I'd also like to note for the record that alternate executive committee member Frank Ciravella is in attendance. It's his first meeting of the executive committee, so welcome. And also in attendance, board member Allison Hirsch is attending via WebEx. The first item of business is to consider the minutes from the executive committee meeting held on Thursday, June 22nd, 2023, a summary of which was included in your packets. May I have a motion to consider?
So moved.
Thank you, Donald. May I have a second?
Second from John.
Thank you, John. Any discussion on the June 2023 Executive Committee meeting minutes? Great. Hearing none, all in favor, may I have a motion to approve the minutes?
So moved.
Thank you, Donald. May I have a second?
Second from John.
Thank you, John. Any discussion? All those in favor, please say aye.
Aye.
Any opposed? Any abstentions? All right. The motion carries. The next item on our agenda today is for discussion and an overview of the preliminary Q4 2023 fiscal year 2023 portfolio performance and a short update on asset allocation. Do I have a motion to consider?
Motion from John.
Thank you, John. May I have a second?
Second.
All right, perfect. All right, so we'll start the presentation and go to the next slide, please. All right.
Point of
So,
information.
yes.
I just want, am I permitted to vote or?
Yes, you are permitted to vote. Tony, you're permitted to vote. You just don't count toward quorum for the meeting, but you are permitted to vote.
Understood. Thank you.
All right, so as always, we'll start and we want to be fairly quick and cognizant of time because we have a large portion of the agenda in executive session. But to begin, as we always do with performance reports, we go through our reference portfolio, global reference portfolio, and the policy PME benchmark. Again, these are different from the benchmarks you'll see in the State Street report that are kind of the overall strategic asset allocation benchmark. For those who are in attendance for the first time, the reason that we use these benchmarks is because we want to see what is the cheapest to deliver portfolio and how is that portfolio doing in reference to a portfolio that's more complex built for you through the Bureau of Asset Management and our consultants. And so we use all U.S. portfolio, a global portfolio, and what we call a public market equivalent portfolio, which instead of using alternatives in private markets, we use the public markets. They're closest public market analog. Go to the next slide, please. So again, these are all preliminary, and this information comes from a combination of State Street, our analysis, and our investment book of record. That for the total portfolio fiscal year to date, again, preliminary 8.35% return, which is above our 7% return. The total portfolio is around $8.5 billion off the high. I think we're above 9 and at end of the fiscal year 2021, but still kind of a healthy returns. And I'll explain this a little bit later. For the fiscal year, the public market portfolios actually performed better than the more complex portfolio with alts. That's kind of an analog to last year where alternatives did a lot better than public markets, right? So it's kind of the flip side of that. But overall, if you look at both the 3 and 6 year returns for our portfolio, they comfortably beat both the global reference portfolio and the policy PME portfolio. You'll see here, for those who are new, the U.S. reference portfolio has done better, and we've talked about that before. In general, U.S. markets, the U.S. equity markets, have outperformed all equity markets over those large relevant time periods. But we have a diversified portfolio investing in international markets as well. We think long term that bodes well for the portfolio having that level of diversification. So if you look at both the global reference portfolio and the policy PME benchmark over those relevant time periods, this portfolio has outperformed, and so the added complexity has added value. One last thing I will say on that is, we use 6 years instead of 5 years for this because that's the time it takes to roll in returns for the actuary for contribution purposes. So we want to look at for us, kind of a market cycle feels like 6 years because if we don't outperform over those 6 years, that starts to mess with the ultimate smoothing and contributions. Want to note for the record before we get, John, go ahead.
Question, how does our 8.35% year to date compare to the other 4 pension systems?
That I am not sure about yet. So we want to look at ourselves. The one thing I will note, and again, because these are preliminary, and it's so close to 8.25. One thing I will note is that if the return is actually 8.35 or above 8.25 in this instance, our actual QPP asset returns will be even higher. And the reason for that is as we've described before, the leverage effect of the fixed TDA. So if we earn above 8.25%, the QPP gets to keep the rest. And so our asset returns might look even better if that number is correct. If it's a little bit below that, then it won't be the case there. But it's funny that this year we're actually close to that dividing line because, again, it actually bodes well for the QPP if we earn above 8.25% because we get to keep the additional assets. Next slide. And also note for the record that Mahisha Sapp, board member Mahisha Sapp is in attendance. All right, so and this is kind of getting at why we underperformed the reference portfolio this year while outperforming it last year. If you look at just the difference between the public markets and private markets for fiscal 2022, our private market portfolio had a 25% or more than 25% return, while the public markets were down almost 17% for the fiscal year. But then if you look at fiscal year 2023, it's the opposite, right? The private markets were essentially flat, and that kind of is skewed. We had good returns in private credit, good returns in in infrastructure, and then low returns in real estate, in private real estate and private equity. But you'll see we had public markets by themselves, our portfolio did 11.5%. So these are just kind of the flip sides of the same, two sides of that same coin, where being in private market kind of buoyed the portfolio in the previous fiscal year and was a small drag on the portfolio for this year. But overall, I think on a net basis over the longer time periods, it all I think kind of balances out and allows us to and essentially underlines our thesis for why adding private markets to the portfolio is helpful. Next slide, please.
Antonio, information question?
Yes.
So I read overall how private equity has, for the first time in whatever time frame, underperformed public equity. And what do you think the root cause of this is? Is this better smoothing, more actualized performance, numbers, or correlation with the equity markets downtrending and some deals coming to fruition? What do you think and I mean, I know this is a guesstimation on your stand. What's your
and we have our esteemed private market consultants here as well, so love for them to weigh in on that. But in general, the valuation, I think it's more that, and you'll see this in the next slide, we actually haven't seen much in distributions. They kind of dropped to their lowest levels they've been in some time. And so, essentially, I think valuation driven, right? At the end of the day, the valuations had not dropped as much as the public markets. And so the public markets have rebounded while private markets kind of stayed flat. And Sandra, and actually, I don't want to add anything to that.
Yeah, and Tony, we're actually going to discuss some of this in our quick presentation, but the short answer is it's just the lag in how valuations are done between public and private markets. And specifically, we're going to look at the difference between US and Europe. And there, what you'll see is just a much bigger investment in tech stocks, both in the public and private equity sectors, which took a harder hit than what you're seeing in Europe. But the short answer is really just the lag in valuation. So the stock markets recover and come back much more quickly than the valuations are adjusted in the private equity books.
Alison, as a
And just to be clear also, the private markets return results that we're looking at now they're on a 3-month lag also, right? So we're looking at public from the end of June, but private just from the end of March. Is that accurate?
Yes. And yes, although I imagine, and I don't know if folks would actually would see, we're not going to see too much of an uptick in those. Like I said, we've been mostly flat and with not a ton of distributions, but yes, there is a lag on those.
Yeah, I assume so. But like the public market really improved between April and June. So
absolutely.
And to Antonio's point, because you can think of it as having bought the companies and paid a lot of money for them. No one wants to sell low right now. And also that's really shut down exits in the IPO markets, as well as the managers selling to each other in strategic acquisitions. So everyone's kind of waiting for the valuation lag to drag down before you're going to see more sales out of the currently held companies. So.
Interesting. Great. Thank you very much.
Say that we are on pace for target in private equity, infrastructure, and opportunistic fixed income. These are both kind of commitments that were made by the board already. proposed commitments for this month, and then, then kind of the annual targets. And so you can see in private equity, we're halfway through the calendar year, private equity, infrastructure, and opportunistic fixed income all are above their, with the proposals above their midpoint for the fiscal year. Real estate's the one area where we have not been. Real estate, obviously, real estate and private equity, we are overweight the target. And so from that perspective, we, that's the one area, but overall, we feel comfortable that we're going to hit the targets that were made by the board and proposed by the Bureau and Axia over the last calendar year. So just saying that we feel comfortable that we're going to hit those targets. And then real quick, one thing I want to kind of touch on before we turn it over to Siegel. And this kind of also is a segue into our discussions on asset allocation, because when we think about kind of long-term performance and which asset classes to think about and focus on, and again, everybody has like a different kind of archetypes. I try to think of the world and how a asset class can contribute to overall performance in three main ways, right? The returns, so ultimately their contributions to outcomes, so the outcomes that we're looking for. Volatility, their contribution to the variability of outcomes, so variability of what may happen. And then active risk, often tracking error, the contribution to the differences in outcome. In this case, the differences in outcome between a benchmark and how we actually performed. And the reason I want to talk about that, if you want to get slides, or at least kind of give you that kind of thinking in mind, is that if you look at the asset classes that historically have had the largest contribution to either return, volatility, or active risk, there's really four: U.S. equity, international equity, private equity, and core fixed income. So those are the four that historically have had the over medium to long time period the largest effect. And so we're not going to go into all this today, but if I had to think of larger themes to think about that we've discussed, in U.S. equity, we've seen some underperformance in our mid cap. The continued effects of divestment and how we discuss those, because actually being underweight energy helped this fiscal year after hurting us the last fiscal year. In international equity, we've had some AM underperformance, and we've seen differences in divergence in how our value managers and growth managers have performed. In private equity, we've seen divergences in how growth and buyout has performed, and also a slowdown in distributions. Then in core fixed income, we've seen divergences in how credit performed versus government, and duration's kind of gotten whacked. And so shorter duration versus longer duration in our portfolio. So in the interest of time, I'm actually going to not speak too much to this slide, just areas of focus in public markets. We've had, for BERS, over 5 years, 2 areas of sustained underperformance. In general, things have worked, right? I think the combination of recommendations and kind of consultant approvals and everything has worked. And so things have worked in our portfolio. So don't want this to be taken as, harping on this too much. But if we're thinking about areas where we should at least be asking some questions, emerging market equity is one, right? Where we have not seen, and this is over multiple iterations, multiple years, multiple cycles, we have not seen a strong performance there. In decades, it's been historically BERS's worst performing asset class across multiple, whatever you want to call it, boards, capital, everything. It hasn't worked. And we have to think about why. And then mid-cap equity, we've had sustained underperformance for a bit of time. And so just things to kind of think about as we're having the conversations with the advisors and things like that, just to think about. And, excuse me.
Hey, Antonio.
Yes.
In reference to the emerging market and the underperformance, in your opinion, is it because of we need to diversify the portfolio more?
We're well diversified in the portfolio. I think for us, so I think there are two things, right? You can think about stock selection, you can think about currency. I actually think the largest is that the valuations in EM just have not been there, right? Like, so if we look at emerging market valuations versus developed market valuations, I think that's the biggest reason. The second, now you're talking about against our own benchmark, so even against the emerging market benchmark. And before I continue, Sheree Gibson, want to note, Executive Committee Sheree Gibson is in attendance. Thank you. That, it's a combination. Actually, if you kind of dive deep, and we're starting to do that a little bit, the stock selection actually hasn't necessarily been an issue, at least for one of our managers, right? And at least preliminarily, again, this is all with those caveats. But looking at, a combination of kind of currency translation, one of our managers having trouble in stock selection. So I think, but this has happened over multiple iterations. So it's something you really kind of have to dig into to figure out why. But the biggest issue is that there's been issues with the beta, right? The beta just hasn't, I mean, they were hoping that comes back, right? That ultimately EM will outperform, or perform to the expectations. But I think there's a number of reasons for that. Currency, stock selection being, and then kind of just general valuations being the top three.
Thank you.
You know, something that you can also look at, just coming from a marketing perspective, is how you evaluate, BERS is long-term investing. And a lot of the emerging market, it's a different type of risk. So, that's kind of like a standard thing. If you're looking for long-term investing, it's gonna have slightly different credentials than emerging market. So, yeah.
100%. 100%.
Is there a handout?
For this, no, these are no handout for this particular one. This was on the handout.
Oh, is there, I'm sorry, I was looking at, do you have, are we gonna get this one in?
Okay, so you guys did, it was emailed to you. So then two more, and then I'll pass it to Salil really quickly for asset allocation before Siegel talks about their kind of views. Connecting between performance risk and asset allocation, I think it's really important because preliminarily, again, if these numbers kind of bear out, we'll be over 100% funded. And so in an era where we are seeing kind of secular cash flow declines, and so what does that mean from a volatility standpoint? How much volatility can we take on? How much volatility should we take on? And then how that volatility manifests itself. And I think that's one thing we've been harping on a lot in these asset allocation conversations. So you can go to the last slide here. And really where it kind of focuses is that private market risks manifest themselves differently than public market risks, right? So if you look on the left, we have our 5-year trailing returns and volatility for 3 asset classes. U.S. equity, high yield bonds, and private equity. Again, these are marked volatility. So this is the mark in our custodial books, right? And you can see private equity has been by far our best performing asset class. And you can, and it's mostly buyout. You'll see in Sandra and Ashley's slides that around 18%, right, in return, with a volatility, marked volatility that's lower than high yield bonds, right? But when we're doing our capital market expectations, nobody thinks that that's the actual volatility of private equity, right? Like the volatility of levered equity for smaller cap level levered equity is higher. So how does that risk manifest itself then? If you're saying we have a better return than U.S. equity and a lower risk than high yield bonds, well, the next, and this is only one way, there are different ways as well. When we talked about lag, and Sandra talked about that lag in valuations, but distributions as a percentage of the net asset value has dropped to almost below 2%, going toward 1%. And so that's just one way it manifests itself. And so as we're thinking about the riskiness of our portfolio moving forward, and the relative kind of marginal weight of public assets versus private assets, thinking about what those tail risks are, what it means for cash flows and how volatility flows through to the actuarial analysis and then ultimately how much cash we receive from the sponsor, I think is really, really important. And on that note, I'll pass it to Salil really quickly to just kind of go through how kind of all of this kind of manifests itself and how we're modeling and thinking about the asset allocation.
Sure. So just a few updates from the last time we spoke about asset allocation and liability risk modeling, which was 2 committee meetings ago. From the liability risk modeling perspective, where we're looking at investment returns and how they match up to funding risk and employer contribution risk over much longer time horizons and at much greater depths, it looked like that combined with the convergence of return assumptions relative to our required returns that we would be taking down risk or wanting to move in that direction. The candidate portfolios that the Siegel Marco folks have sort of put together, they talked about this with the Bureau of Asset Management. I was an observer in that meeting, and also there was a candidate portfolio that I have from the liability risk side. We've hashed out and tried to come up with some sort of convergence that meets people's individual needs on asset classes, so that you can get the top level specifics on return and risk, but then go down to the individual asset class level. the direction we're moving in, and this will sort of, be brought up next month, is just a slight tilt down on the alts complex, a slight tilt up by a couple of percentage points on core fixed income and equities as well. And in doing so, we'll be able to minimize, if we go on that route, the joint tail risks that can evolve over time by these different asset classes. If we go the exact opposite route, take on more risk through alts and other places, we'll have a different sort of liquidity risk profile, and we'll not only just sort of see that risk, but we may not actually get those returns for a number of reasons, from a tracking error, as well as the returns over a long period of time start diminishing even in these asset classes. So looking at trying to minimize the joint tail risks is something that will sort of be a theme as the Siegel folks sort of put together a candidate portfolio, or maybe two, and bring it up next month.
Thanks, Lou. So Vanessa and Frank, you can kind of give your kind of general insights on how you've seen the portfolio perform today.
Okay.
Yes, exactly.
Okay.
Yeah.
So we're going away from asset allocation back to the regular portfolio with the 8.3% return. So again, I think Antonio mentioned it ahead of 7%, but it's really a tale of two halves, the way to explain how the fiscal year did. So if you think about it, the first half that happened in 2022. So 2022 was bad, and the first quarter, so think about it, July 1st through September 30, that was when the portfolio had the largest hit in terms of return for the fiscal year time period. And it had to do with, higher inflation worldwide, the interest rate hikes, how aggressive it was worldwide, the US dollar strength that actually hurt non-US developed and emerging markets. And when you look at emerging markets, the COVID pandemic, while the rest of the world opened up, China did not. And that ended up affecting global supply chains issues. And so those are some of the major things that affected. When I looked at your portfolio for that last quarter, that second fiscal year to date, that ended in December, it performed a little bit better. Things started to rebound a little bit better. But when you look as a whole for 2022 and those 6 months, that was a value kind of environment. And a lot of the managers in your portfolio have a growth tilt, meaning, they tend to deviate more from core to growth type of securities. And that's what hurted that portfolio in those 6 months of the fiscal year time period. When the new year came in, 2023, our second half of the fiscal time period, things started to turn around, returns started to continue to be positive. The fears of the rate hikes started to diminish because it was more known what the governments were doing. So while there was a lot of more volatility in the market, and still there is volatility in the market, there's a lot of up and downs, we were getting positive returns on those quarter fiscal year time periods. I will say that when you decompose it by region, so US equities, most of your assets in US equities are indexed. Actually, you only have about maybe 3.5% that are active in the US equity. So when you're indexed in the US equity market, you're going to be dependent to the ups and downs of the market itself, of the end of the benchmark that you're using. So you are basically getting the return mostly in the US equity from your passive solution there. Antonio is right that you have 15 active managers in the public market side of the portfolio, equities and fixed income. But in US equity, you only have 2 active managers, Wellington and Wasatch. Wellington is the only manager in the US equity side on the fiscal year today that continue to underperform. It's a mid-cap manager. It has a growth tilt. Last year in the second half got in trouble because they had a higher weighting to software and technology software, and those stocks did poorly. This year, they have not been able to beat the benchmark because while the benchmark is going up, they're going up as well, but it's not as much as the benchmark, okay? Now this year during the early banking crisis that has been happening in the US, they had exposure to First Republic, and that hurt them. They were able to get out when the stock was $20, but that hurt them. And they did get some money back from First Citizens because First Citizens were the ones that were able to take the SVB back. So that is one manager on your US side that is continues to or has underperformed on a fiscal year to date. On the non-US side, first half of the fiscal year, all of the managers were underperforming. Once they fit, now that I see the full fiscal year to date, we really have all of the managers in green outperforming in developed. Non-US, the only manager that is underperforming is Exponence, which is a fund-of-fund diverse manager. And that's because they have developed, international, and emerging. And the emerging portion of those fund-of-fund is the one that is underperforming. Not significantly, but they're one of the managers that is underperforming. On the global side, because you have exposure to global, both managers have actually performed very well, both outperforming the indices. And on emerging markets, on a fiscal year today, they are outperforming. I will say long-term, on your emerging market side, the manager that underperforms on their long-term is JP Morgan Emerging Market. It has to do with when you hired them. When the contract was executed, it was 2021, March of 2021. So you think March of 2021 to now, it's a really tough time period for an emerging manager and an emerging manager that most of their investments are in Asia. So it's so it's a combination of yes, emerging markets has not been able to outperform developed international and US, but to this manager, you also have the regional basis of where they're investing that has not been able to come back up to market. So that's part of that underperformance. Fixed income, if I go down to fixed income, last year, all of your fixed income managers ended up last year with negative returns. A lot of that had to do with rate hikes. Things have improved this year. And now I only see two of your fixed income managers on the active side that are still struggling with performance versus the benchmark, but it has to do with duration. The ones that have longer durations are the ones that are underperforming. Everything that had a shorter or more an intermediate duration is actually faring well and is now on the positive side. So it's really, on a fiscal year to date basis, when I think about it, you have to explain it in the two calendar years that it happened, because it's a story of what happened in each calendar year globally, not just in the US.
Is there a standard for that
Standard.
as far as measuring that pocket of time, what happened in 2 years, just out of curiosity?
There isn't a standard. Typically, Siegel Markle writes a letter every year that gets posted for the BERS, and we explain the fiscal year and go, market by market, region by market. And when I looked at your number, right, and I see the 8.5, I said, this is a great number, but I actually broke it out by quarters and then dig in underneath on each manager to try to figure out which were the managers that performed better, which ones hurt overall, because it's two half of the years, and every year that happens, but sometimes it's the same theme that goes from year into the next. But here, the theme changed. 2022 was very value oriented. 2023 so far has been very growth oriented. So it's just the theme has changed. And I think that in order to understand performance, you have to understand not only the time period, but where they're actually, the managers are actually investing and what's happening. And also how the market itself, when you have so much passive, how the market is reacting. I mean, I was talking to a client about just performance for the last quarter. And they were comparing themselves to the S&P 500. And I was like, that's a poor comparison because it's only the top 10 that are giving you all the returns. Everything else is not. So you really have to disaggregate things to be able to, to get to where the issues are.
I had a question.
Yes.
Does Wellington have, who, was I recognized?
Yeah, Tony, yeah.
Yeah, we can hear you.
Yeah, so, does Wellington have further exposure to regional banks? Do we feel that that's gonna be, continue to be a pressure source?
So the exposure that they currently have is for Citizens,
Right,
and they are comfortable with that exposure.
okay.
An active manager, and
Right.
they're comfortable with that exposure right now. Now, I will tell you that when they had First Republic, they got out when it was $20, which means that they got out before it went down to almost zero.
Right.
So they,
But they
they
cut a
are
lot.
constantly reviewing things, but yeah, they do have exposure. Think about regional banks. The only managers that had exposure to regional banks were mid and small caps, because that's where those banks are in the index. That's part of where where they look for things to buy.
Okay, this was checking. I mean, just by nature, you would think that since we're paying up for active management, there should be some outperformance, and it seems like we keep seeing underperformance from our active managers.
Not all of them.
Well, no, you have, so
Not
I
all
would
of
say of 15, you have 4 that on a fiscal year to date have underperformance, so it's the minority. I will say, for a fiscal year to date, Wellington had a 12% return, positive return on a fiscal year to date. It's just the benchmark was up almost 18%. So it's not a
But
bad
they're
return,
mid,
it was 12%, but it's just the benchmark is up. It's at 18, so they underperformed the benchmark, but they're up 12%.
okay, thanks.
Any other questions for Vanessa? Not, then we'll have kind of the last portion of the performance report is from Axia, and they're going to go through one case in particular, European private equity.
So actually, a while back when we were discussing the recommendations for CVC and EQT, which are 2 European buyout managers, Antonio and his team noted the strong performance of the overall European buyout strategy.
Can you speak up a little bit, please?
Sure, can folks hear me now? Thank you. I
can make it
tend
fun.
to speak so so Antonio and his team were intrigued to understand in more detail why European buyout has performed so strongly in their portfolio. And so we looked into that, keeping in mind some of the negative headwinds that have been occurring in Europe over the past year. So just quickly to refresh everyone's memory, overall, you have a portfolio that as of last quarter was valued at $918 million. It's predominantly a US buyout portfolio. If you look on the left side, you see it's about 60% buyout, and of that, 54% is North America. And there's much less invested in Europe at 20% and the other parts of the world. Now, if you drill down further and look at the performance by geography, if I can get the next slide, you'll see that if you focus on the net IRR, buyout has consistently been one of your top performing strategies at 18%. And in fact, I would point out your special situations is really just 3 managers, and one of them switched from doing special situations to buyout. So for Centerbridge 3, which is part of the special situations, it should be in the buyout bucket. But this is good news. You know, for the money that you've committed to investing in buyout, both in the US and Europe, it's done very well. Now, if you go forward and to the next slide, if you look at the multiples, they're fairly consistent. But again, if you look at Europe compared to North America, there has been some outperformance. In general, I would say multiples are better to look at. You can't play cash flow games with them, but cash flows and returns give you faster information about the response. So if you have a long time period, say 15 years, always look at the multiples, but for near-term performance, cash flow can be more indicative of how your managers are performing. So we wanted to dig into that further because if you look at what's been happening in Europe, particularly in the last year, a lot of negative headwinds. First and foremost, the Russians invaded Ukraine. War going on in Europe for the first time in over 45 years. It was expected to have recessionary effects on most of the economies there. And actually, if you flip to the next page, on top of that, two of the major countries, France and Italy, were facing presidential elections. And in both cases, there were candidates running to be respectively prime minister and president that very much were interested in leaving the European Union. So what happened? We're still seeing good performance in European buyout. Well, part of it is the expected impact from the war in Ukraine actually turned out to be less than expected, namely because it was a mild winter. Europe is very dependent on Russian gas. Russia embargoed Europe, but very quickly, especially Germany, went over to getting liquefied natural gas imports, and it was a mild winter. So kind of that stranglehold from the Russian embargo didn't come to pass. And more importantly, for your portfolio, you had very, very little exposure to anything directly or even indirectly related to Ukraine. A lot of the exposure potentially could have come from software companies. There's a lot of software development that was being done there, but your European managers didn't have that exposure. And then secondly, Emmanuel Macron was reelected, and he's very much a pro-EU person. And while Giorgia Meloni was elected and had campaigned on a lot of, we're going to be the next country to lead the European Union, that's not come to pass. She's put together a coalition and seems to be very pragmatic in her dealings with the European Union. So that destabilizing influence has not come to pass. And so some of those negative headwinds have been muted. Now, drilling directly into your portfolio, there are three reasons why you've seen such strong performance in European buyout. First and foremost, out of your top 5 managers, 3 and 5, which constitute literally 10% of your overall PE portfolio, have knocked it out of the ballpark. That's CVC and EQT. So while exposure-wise, you've invested a smaller part of your portfolio in European buyout, the 2 managers that you've selected that represent half of that European exposure and 10% of your overall PE portfolio have really knocked it out of the ballpark. A colleague and I, we also drilled down to see if there were kind of, FX effects. You talked a little bit about the EM. Honestly, that's not the case. The FX is basically a wash and contributing to your exposure. One thing, though, that ties back into the previous discussion about performance is what you saw was this massive correction taking place around any equity growth investments in the stock markets, both in US and Europe. So you saw that downturn and it hit both the public markets and ultimately the private equity markets. Big difference between US and Europe, both in the stock markets that are benchmark indices and the private equity managers, heck of a lot more investments in tech companies relative to Europe. Europe did not go quite as tech crazy as the US private equity managers. So as you've seen those corrections take place and the recovery in the stock markets, essentially, while you've seen less impact from that downturn in the tech sector in Europe. And also what you are still seeing is that lag effect, because the numbers we're looking at here from the last quarter. And so while the overall negative headwinds for last year were much less than some analysts predicted, you are still seeing that 3-month lag. And then the final point, which I'm going to make, which is kind of like a math nerd, which I am point, your portfolio is really heavily weighted by number of private equity managers and the actual exposure to to the US. So if you kind of do the averaging, it's averaging down to a medium that's lower than for Europe because you have just fewer managers and a smaller exposure. But the main answer is why you have such a well-performing private equity portfolio, particularly in European buyout, is you have concentrated in 2 very high-performing managers, which you as a board just reviewed. So,
Any questions for Sandra?
Can I add?
Sorry, I didn't know. Oh, I thought you were.
And again, since originally my family's Eastern European, it's not all rah rah sis boom bah. I did want to add one or two slides saying that things are slowing down in Europe, both in terms of the fundraising and the investment activity. So our expectation going forward, for example, if you look at the fundraising, it hit a peak in 2021 where over 216 private equity funds in Europe were, raised, dropped almost half that amount. And what you're seeing is now 16 a year, through the first quarter. And that also is paralleling the deal activity. So it crescendoed and now it's dropping down. A large part of that is what we mentioned earlier. They paid a lot for companies. They want to sell them at a good price, so they're holding on to it. And if you flip to the next slide, you'll really see that, and actually it's both true both for the US and Europe, the IPO exit market has really vanished. So going forward, what we expect to see is a tremendous slowdown in distributions for all of your private equity managers, including Europe. So while you have a very well-performing portfolio, things are slowing down, and just kind of the Eastern European immigrant in me is saying if you don't expect such high performance necessarily going forward, the main thing is going to be a real slowdown in distributions.
Sandra, are buyout funds in general the most popular of the PE strategies?
It varies by the type of institutional investor. Within the pension space, that is very much true. If you start looking at endowments and foundations, they tend to tilt it more towards venture capital and growth equity. And that's just a function of higher risk tolerance. You don't need to put out as much money to support, paying out benefits for your retirees. You're just putting out a smaller amount to support usually a university or a hospital.
Yeah. Do you think the slowdown is anticipated like a 2-year, 3-year term, or 5 and higher year?
It's a very good question. Part of it's going to depend on whether the banks stop raising rates. Yesterday I went rah rah sis boom bah, 3% inflation. Maybe we're done with the Fed hikes here. And in Europe, it's a little more complicated. We talk about it as one region, but and actually the European Central Bank does the same thing as our Fed, but there's a lot more discussion because the inflation is different across the different countries. So it's a very good question. It's going to depend on the inflation coming down, which I think will vary by country. So I think it's going to be uneven, but it's not going to happen quickly. I hesitate to put boundaries around it, but that's the key thing to watch. And when the ECB stops cutting rates, they're similar to when it stops raising rates, and just like with the Fed.
Thank you.
Yeah, we've watched the systematic marks over time in our PE exposures. The distribution is, I would say, wild, from about 6% to 33%. Is that kind of the distribution? And the idea that, sales out of these funds is declining kind of gives me concern about how they're valuing, right? So if they're not selling, it's clearly that marks are below what they believe they will be long-term. What are your thoughts about what that means for the next few years of returns?
You will see much slower distributions. The reason valuations are high in general is because we were almost in a 10-year period where interest rates were abnormally low. So essentially all private equity buyout firms almost had free money to do the borrowing to buy the companies. That's changed. So the good news is it's not a function of any manager. Valuations in private equity and literally in just about every asset class got expensive because money was so cheap in the US and Europe coming out of GFC and stayed low. So there's a big overall correction happening in all risky assets. I mean, for the first time in 10 years now, you're buying treasury bills because they're putting out meaningful yields. So it's going to take a while for those to adjust. Typically, the private equity managers do one of two ways of marking their books. One is comparing it to the pricing you're seeing in the public markets. And that has definitely changed. Now, they're slow to do that, but the public market equivalent is one way of doing it. And the groups that tend to do that for their books are marking it down more rapidly. And you're seeing that a lot for the tech investments. As of last quarter, the tech investments have typically, using PME, have been marked down anywhere from 10 to 40%.
So marked down from with Will?
Private market equivalents. So one thing you want to, kind of keep an eye on is how much is your private equity manager paying in terms of the price relative to what the pricing is being done for public companies in the markets. And so
Tech is down from between what and what? That's what I missed.
10 to 30%, the private equity managers, because there's been such a drop and a little bit of recovery now in the publicly listed tech companies. If they're using this method, saying, I'm comparing it to what I'm seeing for similar companies in the stock market, they've marked that down 10 to 30% as of last quarter. Some, though, do discounted cash flows. And that's kind of, it puts you in the driver's seat of kind of thinking and making assumptions about how much money you're going to make and how much is it going to cost you to run that company. And let's just say there's a lot of room for creativity in that.
Yeah.
And that's where you're still seeing the most amount of resistance in adjusting those valuations down.
So I'd like to follow up on that. So I've got a bunch of kids who bought houses in the last few years, and the most valuable asset they now have is that mortgage, because they probably made more on that mortgage as it's marked to market than the price change on their home if it went down, but it's cost of up. That suggests, however, that the time frame for these funds is going to be key in terms of understanding how interest rates change, and they are forced to sell as they move to liquidation. Because how do you capture value on a balance sheet when it's debt by selling a company? Because most of those financings have to end on the sale of a company. This is a big concern I have.
But the nice thing is, unlike being underwater with the house, is that the leverage coming out of the leverage loan space, they're not over leveraged. And I would say the vast majority of the value of the companies is well beyond the amount of money they've borrowed the leverage.
Okay, even as compared to public markets, you'd make that
Yes,
argument?
yes. I want to be clear, no one's underwater. They're just going to have to mark down the values because they bought them during a time when everything's expensive.
Okay.
And there is, fortunately, there's
But
also.
to that point though, Sandy, like, I think I mentioned.
I know, Tony, I just want to say one thing, Tony, look at your question, but we'll also want to be cognizant of time.
It's a good point.
Just as a.
No one's underwater.
Because we do have some items for executive session, but go ahead, Tony, just wanted to put that out there.
No, just, I agree with the thesis, and it does concern me as well, I guess is the point. I saw managers bring deals public before the drop last year, and they looked horrible. And they were looking at like over 20% IRRs prior to that. It's problematic as we, as a pension fund, as we look at our numbers overall. So I don't know what the answer is, but it seems like it's going to be a continuing problem.
Yeah, Tony, it's the junk bond banker in me. FP&A guy at a private company knows exactly what that company's worth compared to what they paid. And it's not clear to me that that's being reflected in the marks.
Agreed.
It will take a while to adjust now, but I'm confident in saying, and having looked at the deals in your portfolio, none of them, or the majority of them, are not underwater. And also, as you know, there will be recapitalizations done.
Yep.
It may be more expensive to do that. Plus, as an LP, it depends on whether it's the manager or the LP in the driver's seat, but you can say, okay, this is not the best time to sell it. Our fund is coming to its 10-year limit. Let's wait another year. But in addition to banks, there's a lot of activity in the private credit markets, which will allow for recapitalization. I think it's only groups that were reliant on financial engineering to make their returns that are going to suffer, but that is not the case with your portfolio.
Thank you, Sandra. And so we want to make sure that we're continuing to give you all these type of updates from Siegel and Axie as we're going through the portfolio performance. That is actually the final item for public session. The next items on our agenda are an executive session. Do I have a motion to enter executive session? So thank you, Donald. We have a second. Second, Sheree. Any final discussion? All those in favor of entering executive session, please say aye.
Aye.
Any opposed? Any abstentions? All right, the motion carries. We are now in executive session. I'll now report out on executive session. In executive session, the board received a presentation from one of its investment managers on diversity, equity, and inclusion practices and asked for additional reports in the next 6 months. In executive session, the committee approved a commitment to one opportunistic fixed income fund and one real estate fund. That is the final item for the meeting today. Before we adjourn, I wanted to ask the committee if folks would be available for an August meeting. Given the timing of the July meeting, there are a few funds that we're not able to get to this month. In addition, we postponed another diversity, equity, and inclusion presentation to have our discussion today. If so, and I just wanted to open that up because it would be the day for August 17th, but I know August are pretty difficult for folks, so.
17th, you said?
Yes. Not here, no, me and that. Right. So it looks like September is gonna have to be it. And so if that's the case, then, I mean, I was gonna say like the
PEP meeting kind of.
is there a PEP meeting in August?
I don't know that they may move that.
Yeah.
We can come, why don't I come back to folks with
Was it August 16th?
but oftentimes those get.
Yeah, they get
So,
canceled.
What if I come back to folks with,
Gonna have a meeting.
yeah, what if I come back to folks with a doodle poll or something like that, so we can get a temperature from the room on whether or not it's possible? And if it's not possible, then we'll hold the meeting in September.
Is there anything that's time sensitive that needs to be done in August?
I think the two funds were separate accounts, and so neither of them are closing. So essentially, because they're accounts that are just gonna be New York City, we can close at any time for those two funds. So it's not, that's not time pressing. I just do like with the momentum around diversity, equity, and inclusion, the Linux Park information, the stats from all of our managers would carry right over. I mean, we can have one-on-one conversations on those as well, prior to kind of a presentation, if an August meeting doesn't work, so we can call folks and go through those numbers as well, so.
We could do it virtual. It would make it a lot easier for people to be able to attend.
Can't do that.
Yeah, so what, how about this? How about we say we have I'll doodle poll, see if it's possible.
I'm just
If
saying
not-
do the doodle poll.
Yeah.
To see if it's possible,
Yeah.
because I guarantee you, by September, that meeting gonna go to 6 hours if we don't do something.
So I will doodle poll. I'll send out a request from everyone to see what time
How does the board meeting agenda look? If it's light,
this board,
do we do it?
yeah, 2 weeks from now, 25th. So I'm on vacation. So I mean, Keith, you want to take care of that one? All right, so what?
I like that idea. Just in an hour or two.
You're important.
Not that important, right? So if that's ready, y'all ready to take care of that? That's great.
Yeah. We'll look into that.
Okay, absolutely. So if that's nothing, do I have a motion to adjourn? Motion. Donna, second, Sheree. All in favor of adjourning, please say aye. Aye. We are now adjourned. Thank you.